The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Very good morning to you this Tuesday. A warm welcome to Squawk Box Europe. I'm Steve Sedgwick with Ben Boulos, and these are your headlines. The US launches its blockade on Iranian ports in the Strait of Hormuz, but hopes for further dialogue help ease oil prices back below $100 a barrel. President Trump says Tehran wants to strike a deal.
We can't let a country blackmail or extort the world, because that's what they're doing. They're really blackmailing the world. We've been called this morning by the right people, the appropriate people, and they want to work a deal.
Hopes of a deal help to lift global equities higher. On Wall Street, the S&P 500 erases its losses since the start of the war, with Asia also tracking higher overnight. Elsewhere, LVMH sales miss expectations as the Middle East crisis weighs on growth and puts a dent in the luxury giant's strategy to reinvent itself and win back customers. Its US shares closing some 3% in the red.
Have we all gone crazy? It's because I'm just looking at two worlds at the moment. I'm looking at my market job, the world I'm looking at markets, and I'm looking at the real world. And unless the market knows something really subtle and really smart that the real world doesn't, then there is a massive disconnect going on here. Let me just take a step back. Did you just read this? Hopes of a deal will lift global equities higher. Wall Street, the S&P 500 erases its losses since the start of the war. You did just read it, because I heard you read it.
I did.
I am... Look, I've been around a long time, an old man, and I'm always a little bit too cautious and all of that as well. But the VIX is sub 20. It is trading at 19. The S&P has lost nothing in aggregate since the start of this war as well. And oil prices, by the way, when we say we can get this up again because I do this sketch every day. When we say that they're below the oil price, if you could, Roger, that'd be great. $99 a barrel or $98 a barrel, that is nonsense. If you want oil today, you are not paying $99. You are paying $135, $140, $149 a barrel. Trust me, that's what the Asian refiners are paying for various dated benchmarks as well. So you've got this disconnect. You've got the oil prices in the market on the futures contracts, which are low. You've got the VIX, which is low. You've got the S&P, which is flying high. The market is so sanguine. And yet the world is short of helium, by the way, which is needed for semiconductor production. The world is short of fertilizer, which is kind of what we need, world, for food. Yeah, everywhere. And the world is short of product in terms of LNG and various oil products and various refined products. And I keep seeing headlines about how the last shipment of jet fuel has gone here, or the last shipment of refined product has gone here as well. So unless the market, don't get me wrong, I hope the market is right, because I am sick of this war like the rest of us. Now, whatever the ethics of it are, whatever who's right and who's wrong, we can put that aside. The fact of the matter is, it's a conflict and it's not great for the world as well. But isn't that extraordinary? How sanguine, how relaxed the market is compared with every bit of evidence that this is creating enormous disruption as well. Let me know, steve.sedgwick@cnbc.com. Genuinely, you want to chat? I'll chat with you.
I'll let you know. I'll let you know my thoughts.
Steve, no, you got to email me. You got to email me. Steve.sedgwick. Sorry, I had to get it off my chest.
I have privileged access here. Every day I stand and do the markets, I look for patterns. What is the narrative around it? The pattern that tends to emerge in recent weeks has been when oil goes up, equities go down and vice versa. Yesterday, even that pattern was thrown out. Oil prices up 4%, Brent crude up 4%, light crude up 2.6%. All of the main averages in the US also went up. There's a disconnect between the pattern that we've seen before and the fact that the S&P 500 has erased its losses since the beginning of the Iran war. There's a really interesting insight from the guest that we've got coming up on this about how quickly markets recover from geopolitical risk versus geopolitical shocks versus financial shocks. Really interested to get into that with him when he comes on set.
Because guess what? they're not unrelated as well. One can cause t'other. I've seen it 100 times. Thank you for that. And if you have any more comments, Ben, just send it to me at steve.sedgwick@cnbc.com. There is normally a barrier on there. Thank you, sir. Right, OK, let's get back to the facts. A US blockade of Iranian ports is in place after the weekend's peace talks in Islamabad failed to produce an agreement. Now, we know this back channel is still going on, but the actual JD Vance and the top-level Iranian delegation failed to produce an agreement, with the US President Donald Trump saying Tehran wants to make a deal very badly. OK, speaking Monday, Trump explained what the sticking point was in negotiations.
It's over the fact that they will never have a nuclear weapon. Iran, you marking it down? Iran will not have a nuclear weapon. And we agreed to a lot of things, but they didn't agree to that. And I think they will agree to it. I'm almost sure of it. In fact, I am sure of it. If they don't agree, there's no deal. There'll never be a deal. Iran will not have a nuclear weapon, and we're going to get the dust back. We'll get it back either. We'll get it back from them or we'll take it.
Washington and Tehran are reportedly still talking, with discussions taking place on holding another round of negotiations before the current ceasefire expires. That, according to multiple outlets. In a call with his French counterpart, Iran's president said the country is open to talks, but only in the framework of international law, according to state media. Well, hopes for a diplomatic resolution to the conflict, as I just mentioned, are continuing to push prices lower this morning. But Dan, the fear is that all this product that isn't being refined in the Middle East, that isn't being shipped from the Middle East as well, is going to store up even bigger problems as well. But just tell me how things are looking from your lens.
Well, Steve, good morning to you. First of all, oil markets seem to be holding their nerve here. And of course, we're looking at front month Brent and WTI here. A lot of the Gulf spreads are also looking a little bit more elevated. But on balance, oil markets holding their nerve. Brent and WTI trading below $100 a barrel as traders weigh two things here. The first is this dual blockade in the Strait of Hormuz. And the other one is, as you mentioned, hopes of a diplomatic breakthrough. Firstly, on the diplomatic front, we are seeing fresh reports that both sides could return to the negotiation table before the ceasefire ends on April 22nd. The Vice President JD Vance said overnight that the ball is in Iran's court. And as you heard there, President Trump says he's confident that Tehran will ultimately agree to abandon its nuclear program. He warns there is no deal without it. Of course, the Iranians have so far refused to give it up. And then on the water, this US Navy blockade of all Iranian ports is now in effect, enforced by more than a dozen warships. Iran calls this piracy and has put its armed forces on maximum combat alert. So far, the UK and France have not committed forces, and instead they're convening their own talks on restoring freedom of navigation. That's a view shared here in the Gulf, where we've heard from the likes of the UAE, for example, suggesting they would be open to join an American-led effort to reopen Hormuz, but stop short of announcing any serious action. And there are already some signs that the blockade is being tested as well. Reuters reported overnight that a sanctioned Chinese tanker, it's called the Rich Starry, had become the first vessel to exit the Gulf since the blockade began. That tanker and its owner were previously sanctioned by Washington for dealing with Iran. So it's interesting to see perhaps some movement as a result here. Part of the reason we're seeing oil prices come down is because the worst case scenario has so far been avoided, which is the direct seizure of tankers or strikes on ships themselves. And then there's also fresh insight from the Gulf as well. Saudi Arabia pushing for this blockade to be dropped, wary of an Iranian response that could potentially shut down the region's last viable oil export route. This is via the Wall Street Journal reporting, citing Gulf officials, that fears in the Gulf are growing that this US blockade could push Iran to close the Bab el-Mandeb. And of course, if that happened, then it would create further disruption, not just to shipping, but also energy and goods as well. So a lot in balance as we continue to monitor the progress of this ceasefire and also this competing blockade in the Strait of Hormuz. I was speaking with experts on Access Middle East earlier today, trying to get a sense of exactly what's happening on the water. It's pretty hard to get a decent handle on the current state of play just because of the lack of transparency and the limited reporting that's actually coming out of the Strait of Hormuz. One question that I was asking right now, at least earlier today, was is America effectively in control of Hormuz? Or if not America, then who is? And of course, a lot of experts that I've spoken to don't necessarily have an answer to that question right now, because under international law, no one can control Hormuz. But this dual blockade is, of course, keeping markets on edge. And at the moment, there's no signal that the US is willing to end the blockade anytime soon, and certainly no messaging from the Iranians that they're willing to stand down either. So all eyes are on the Strait to see exactly what happens next.
OK, Dan, thank you very much indeed, as ever. Let's have a look at how all this is playing out on the markets. And this was the picture on the US markets at the end of the Monday session, posting a strong start to the week with some solid gains there across all of the major averages. The Nasdaq leading the way, up 1.5% almost. The S&P 500 up 1%. The headline from that, the S&P thereby erasing the losses that it had seen since the start of the Iran war. The Dow also up by almost 2/3%. You can clearly see the optimism taking hold in the equity markets that the talks, whether they are direct or through back channels, could lead towards some sort of resolution. That's despite this blockade that was brought in that Donald Trump announced of the Strait of Hormuz. It was interesting, just one company report to pick out, Goldman Sachs kicking off the earnings season for the banks. The shares declined after the company's first quarter fixed income trading revenue fell by 10% compared with a year earlier, and that overshadowed some other fairly positive numbers.
Yeah, but hang on a second. They're trading like 3 times the value they were about 5 years ago, and they're trading at 2.4 times price to book. They are a beautifully priced company. I don't think there's any problems at Goldman's, is there? No
problems at Goldman's, but I think if investors were focusing on that, whereas that's despite them posting, I think, their second best ever quarterly.
Look at the chart.
Quarterly
results.
Look
where they've come from. I mean, this is a very big stock. Anyway, sorry.
It is. Anyway, we'll dive into that in more detail later. Just explaining it in the context of the markets, and the optimism we saw on Wall Street clearly filtered through to Asian equity markets. You can see most of those in positive territory. The Nikkei leading. Oh no, not the Nikkei. It's the Kospi leading the way, just slightly higher, 2 2/3% up. The Nikkei also advancing significantly. And interestingly, the Hang Seng and the Shanghai markets also up. That's despite some data out of China showing that its export growth lost some momentum in March. Manufacturers grappling with rising commodity and energy costs as a result of the disruptions to supply from the Middle East. Will the optimism play out when European markets open for trading this Tuesday morning? Well, the future's pointing to a moderately positive picture, but the FTSE just lagging its peers and the wider stocks 50 if those futures prove to be correct. We'll find out in 48 minutes from now. Let's bring in Patrick Farrell, who is the Chief Investment Officer at Charles Stanley. Patrick, very good to have you with us.
Thanks.
Steve and I were talking at the start of the show about how equity markets seem to be telling a very different story to the news flow and the reality on the ground. What do you make of that?
I think equity markets do like a positive story. And I think all investors at the moment just want to see any sort of positive news coming out and rally off the back of it. I think some of the comments that were made this morning, particularly around the US market rally, obviously the US is not in a position where it's going to be as impacted as other parts of the world by this geopolitical conflict. But that doesn't mean it's immune from it on some of the things. We've seen gasoline prices up 33%. So those are the sorts of things that I think are going to really sort of come home to roost for the US growth potential. So from that perspective, do I think the market's a little bit over optimistic in terms of where it's sort of pricing things at the moment? Yeah, when we look at this, is this something that's going to go away quickly? I mean, that's the key question that we've got to ask ourselves. Can we get back to a supply chain, a free flow of oil and free flow of energy, and actually get supply chains back to normal? I think that is still an uncertainty that's going to plague on markets. However, we are going into an earnings season where some of the earnings expectations for some of these companies are at ridiculously high levels. So there's a juxtaposition. Where do we actually sort of position ourselves?
There's ridiculously high, and then there's, I suppose, it tips into unrealistically high. And given your outlook, I suppose everyone wants to know what is coming down the track. And looking at your the research paper, you point out that we're in a period of elevated geopolitical risk.
Yep.
And that geopolitical volatility will remain entrenched. So in which case, how can companies be so sure? How can investors be so sure that these ridiculously high expectations of future earnings will actually play out when there's so much uncertainty around the rest of the world around it?
I mean, a lot of these big companies, they operate on a global scale. So they've had to come up with a way to position themselves appropriately. Now, I don't think that they're necessarily going to have a political analyst sitting in their strategy sort of sessions, but that could be the case going forward. So that now that some of these big companies have to liaise with politicians, with the current sort of sitting party, and try to figure out what is the policy initiative and how they can have policy certainty, both from a geopolitical front and also from a domestic front, in order to sort of figure out what strategy that they're going to have.
Love the word juxtaposed, up there with only flabbergasted and codswallop and some of the greatest in the English language. I agree, but juxtaposed against all these fears and juxtaposed against these extraordinary valuations is the fact that I trust the best company leaders more than I trust the world leaders better. So what I'm saying is, I actually think the best in class of companies, and having just said that Goldman's is trading at 2.4 times price to book, which is an astronomical valuation, I probably trust the leadership of the investment banks more than I trust the leadership of governments to manage their sovereign commitments properly. So quite apart from the war as well, what I'm trying to say in a very roundabout way is that actually the safe haven status of the top companies, I think is almost underrated compared with the safe haven status of the top rated bonds.
I think, when you're trying to figure out what strategy you need to actually adopt, companies can be a lot more adaptive. That they adapt to the changing environment. And I think from that perspective, they've got the flexibility in order to do that. Are they looking for the next election win? Are they looking for the popularity piece? No. And I think that that's the sort of challenging factor that we've got in a world where, we have to sort of look to the next election for the political leaders to try to figure this out.
CIO, has your view changed on 60-40 in the last couple of years?
So I think there is a strong basis for a 60-40, but we have to have other elements in a portfolio that act more as a stabilising mechanism. I think that's one of the sort of key things, that if you try to trade these markets in very, very volatile times, it will be a very painful exercise.
See, you say that to me, Patrick, and I'll take you at your word, and yet I see the move from CIOs actually moving in the opposite direction. You're saying there is a need for stabilising forces. Actually, I see a move where people are putting more risk on the table for clients via private markets, via hedge fund exposure, via alternatives exposure. And as much as those things may deliver an outsized return, a kind of power law return, I don't see those as stabilising forces. What I see them as is potentially destabilising forces, certainly for people with their portfolios, dare I say it, at my age in life.
They definitely introduce different risks. And when you start to think through, when do these things get tested, particularly private markets, and we're seeing this in the private capital space, that when they get tested from a liquidity perspective, you suddenly find that, those particular investments, I didn't realise were going to behave in that particular way. So from a CIO's perspective, what becomes very, very difficult is trying to sort of marry up what are the different elements that could play out over the course of a year for our clients' portfolios, and then making sure, have we got some of that sort of reflection? Let's say we do have a geopolitical event, then we can't actually invest a portfolio on the probability that this is going to happen. This is one of the sort of key facts, that if you basically had too much exposure in one particular thing because you thought there was going to be a geopolitical event, then as soon as that event plays out, and this is part of what we've sort of written about, as soon as that event plays out, the markets will start to rally quite aggressively. So yes, it's good to have stabilising mechanisms in the portfolio, but it's also really important to understand how these things can play out in the future.
I like the analogy you draw in the note. Just as a Pilates instructor emphasises strengthening large stabiliser muscles in the body, you need to do the same for your portfolio. So I suppose my question is, what is the portfolio equivalent
Yeah, but there's certain things in Pilates I can't do.
Well,
regardless of how good it is for my core and my strength.
The boomerang, the control balance, the corkscrew.
Yeah,
What's the... And that's just before breakfast. What's the equivalent of those, then, the stabilisers, in a world where we've seen gold moving in the same direction as equities, volatility in government bonds that would normally be a traditional stabiliser? Where do investors find those stabilisers?
Well, I think this is part of the point. So the large asset classes do all the heavy lifting, right? So those are your quadriceps, your biceps, and all that sort of stuff. They do all the heavy lifting. That's what's going to provide your portfolio return. How we can sort of mitigate any sort of short-term risk is like having commodities exposure in your portfolio, not gold miners or oil refiners or anything like that. It's actually the commodities themselves, exposure to that, because that's the only thing that's going to protect you in a geopolitical event. But do we put a huge amount into a portfolio thinking that, yes, we're going to see more geopolitical events coming through? That's a certainty. Yeah, we are going to sort of see, okay, I'm going to provide a little bit more stability to help my larger muscles actually provide the real driving force behind a portfolio.
Guys picking up the Pilates thing.
It's great, isn't it?
Well,
I want to move on though, because I wonder if we're. I was going to keep the analogy going, but I'll just keep. Are we concentrating on the right strength thing? I don't know, whatever. But I'm concerned, as ever, that it isn't the war that a lot of the market is selling off on. It is a derivative of that, and that is the higher cost of money. Because and the inflation. I think what this has really shown is how tenuous a lot of the bull market thematic investment cases are, given the fact that they were premised on lower interest rates. If they are premised on current interest rates or slightly higher interest rates, I think a lot of the case for the investment in a lot of these sectors, and dare I say it, very highly leveraged companies, is actually built on on sand and what have you. And it's a house of cards. And I would worry that actually it's the cost of money that everyone's more worried about rather than the war.
I think the element, and this is where some of the regional diversity starts to play out a little bit more. In the US, all policy initiatives are basically moving to a more stimulatory environment. We've seen big tax checks come out for the consumers. They've gone out and bought a whole lot of bigger cars off the back of it. Now they've got to fuel them up, so that's a bit more of a concern. But if I look at Europe and I look at the UK and Asia, we were just coming out of some of that sort of economic doldrum. And I think that is where the real upsetting news has come through, because we've now got central banks thinking, actually, we've got to tighten rates. We can't actually cut rates, even though the higher oil prices are a tax on the consumer.
Patrick, we need to leave it there. Thank you for coming in. Also, thank you for picking Pilates as the sport of the day. I did fear at one point, as a proud Aussie who loves his cricket, you were going to go a different direction, but we'll take Pilates.
We could have done that.
No, let's not do the other. Thank you, Patrick. Let's end on friendship. Patrick Farrell, thank you very much indeed for that. CIO at Charles Stanley.
Thanks very much.
Still to come on the show, Chinese exports grow at their slowest pace in 6 months amid headwinds from the war in the Middle East. Plus, LVMH misses on first quarter sales, with the luxury bellwether also citing risks from the Iran war. And as airlines grapple with surging jet fuel costs, we will discuss the impact of the war on aviation with ING's Rico Lumen. That conversation at 9:30 London time.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick, and here's the CEO of Siemens Energy, Christian Bruch.
Business leaders should not stay quiet in a world which is super complex. We sit in a privileged position, and we have to use that to ensure that a society remains prosperous, stable, successful.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
Welcome back, and let's bring some breaking news. The Spanish Prime Minister Pedro Sanchez has met the Chinese President Xi Jinping in Beijing as part of his fourth trip to the country in 5 years. Pedro Sanchez speaking now. Both leaders pledged to deepen cooperation and safeguard world peace against what President Xi called a crumbling world order. We've had lines from what Sanchez, he's speaking in Spanish, but we've had some of the lines coming out of that. He described international law as being undermined repeatedly and dangerously, but adding that international law more necessary today than ever. And in terms of the relations with China, he said, if China and the EU understand each other and cooperate, their societies will benefit. Steve, are there other lines you wanted to pick up on?
Okay, let's cut to the chase. They're talking about the Americans here. Let's not. We'll cut through all the flim flam and all the diplomatic niceties. Sanchez says those of us who speak out against governments violating international law are being threatened by those countries. He's talking about America, isn't he? Let's be brutally honest about it. He's talking about Donald Trump. And we know that Sanchez and Trump have beef anyway. They have beef over NATO, which, by the way, I agree with Trump about as well, because the Spanish are the only ones who said we don't want to give 3.5% plus 1.5%. So let me put that on the record. The Spanish were the only ones who were the holdouts at NATO, and Trump was right about that. But what he's also saying is that those who speak out against international law are being threatened by those countries. I mean, he's talking about America. Take a step back, everybody. You've got the leader of one of the biggest Western democracies. You know, they've had their problems with military dictatorships in the past, but for the last 40-odd years, they've been a Western democracy, is discussing with the leader of an authoritarian regime, because that's still what China is, and again, I'm not slighting anyone, reforms for the multipolar system. Well, I studied this, right? The Bretton Woods world, the IMF, the World Bank, all these international organizations was set up by the Americans with Western support to get some form of liberal democracy hegemony on the way that international law is set up and transactions are made as well. But you've now got the Spanish and the Chinese basically talking about the Americans and saying we're going to reform things in the multipolar world. It is crazy, the stuff that's going on in the world, and just shows how dangerous the current situation is, even after this war has ended.
Indeed. We will continue monitoring that and bringing more lines out of it as and when we get them.
Chinese exports grew at their slowest pace in 6 months in March, missing estimates as the fallout from the conflict in the Middle East hit manufacturers. However, importers saw their strongest growth since November 2021, up 27.8%. Wow, more than double expectations. Let's get this broken down now with Elaine, who joins us with more. Elaine, nice to see you.
Hey, Steve. So this is the first month of trade data since the war in the Middle East, and the impact is already clear. And even if China is relatively immune to the closure of the Strait of Hormuz and the global energy shock, thanks to its oil stockpiles and diversified energy mix and its renewable energy push, the conflict is affecting China's key trading partners, and that is casting a shadow on China's export-reliant economy. Now, exports sharply missed forecasts, growing 2.5% in March. That's the slowest in 6 months, and slowing from a nearly 22% surge in the first 2 months that was driven by chips, autos, and ships exports. And indeed, China's AI-driven export engine helps lessen the blow from this conflict as the demand for chips and servers remains strong. But it's not enough, it seems, to offset the fallout from this war. Now, fading global demand is, of course, putting more pressure on exporters who are also grappling with rising energy and commodity prices. And if you look at ASEAN countries, China's largest trading partners, with some markets that are especially vulnerable to the oil crisis, like Thailand and the Philippines, exports to ASEAN markets grew 6.9% in March. That is roughly a quarter of the growth recorded in the first 2 months of this year. While exports to the EU, China's second largest trading partner, rose 8.6%, and that's slowing from the nearly 28% growth in the first 2 months. Now, the first 2 months are combined in 2026 because of distortions related to the Lunar New Year. And there are other factors behind the slowing export growth as well, like a high base, as Chinese exporters rushed shipments last year to beat Trump's tariff deadline at the time. And Beijing has acknowledged these challenging times now. China's customs vice minister said the country's trade is facing a, quote, complex and severe environment with global oil prices sharply fluctuating. Meanwhile, imports surged 27.8% in March. That's the strongest growth since late 2021. So we see the value of imports rising because of tighter global supplies, but also some analysts point to seasonal restocking among steel makers that are expecting better demand. But I also want to point to how imports from South Korea surged more than 62% in March, driven by higher memory prices, given all the shortage, and also AI server demand, and that is usually a sign of manufacturing activity in China. So overall, we see China's trade surplus in the first quarter shrinking 3% year on year compared to the same period, and economists say that China cannot fully pass on the higher energy costs to global customers. So we see now China's trade surplus narrowing as well. But we'll have to look for more data in the coming months to really understand the impact of the war on China's export, which is a key growth engine for China, because there are all these noise and distortions from the March data. So that's something we'll keep tracking very closely.